Second topic in finance of AS2 is break-even analysis. And break-even analysis is more or less a repetition of what we do at GCSE. But this time we add a little bit more emphasis on the concept of contribution, which, as we know, is part of the bottom line of the calculation of the break-even formula, selling price minus variable costs. So, first of all, the concept of break-even, how it is measured, how it is represented graphically on a graph, and understanding the movements in costs, of course, and revenue that may affect the movement of the break-even point, increasing or decreasing, and what those consequences would mean for a business. So, before we look at the formula for break-even, just a quick recap on the understanding of costs and revenue. So we know that cost is money going out of the business and revenue is money coming into the business from your sales and what you're selling. As we know, profit is all about revenue minus costs, but of course, when we explore that further, that's total revenue that you earn in a business minus the total cost. So we have to understand total cost, what's that comprising of? So we know total costs to be made up of what we call fixed costs and variable costs. Fixed costs are costs that do not change with output changes. So if you're a factory and you're not producing on a period of time because you're closed for holidays, you still have overheads that the factory or the business needs to pay, even though you're not basically making anything. Or indeed, if you are a business like a barber's or a hairdresser, service-based industry, if you're not cutting or styling hair because you have days off for seasonal holidays, you still have overheads to pay. Likely you're renting your premises and you have insurance on your premises, and you don't get deductions out of rent for days closed or deductions out of your monthly insurance for days closed. So they are fixed costs or overheads. Variable costs then are obviously costs that do change with output. So physically, if you're making more or you're trading more as a service industry, and the two key variable costs that would be easy to remember as examples are raw materials and wages. And sorry, I should say fixed costs, anything like rent, rates, salaries, even insurance costs, electricity, heating, power, utility bills are all fixed cost examples. So when you add your fixed cost and your variable cost together, you get your total cost of the business. So again, to recap, profit is total revenue minus total costs. And our total revenue calculation, as we know it, is selling price multiplied by quantity sold. Okay, so what you ideally want to do is, as a business, is have as much revenue as you can coming in, and obviously to squeeze your costs as best you can. And ultimately, you want the lowest break-even point that you possibly can have or manage in a business. So just to go over the definition of break-even as a concept, okay? Break-even means the point or position where total costs equal total revenue. So TC equals TR, okay? And why is that important? So it is very important because the break-even quantity or break-even point can show the amount of goods which must be sold in order to make a profit, the level of costs which the firm can afford to cover. So it knows its costs, then it knows how much it has to actually cover those costs before it starts to make a profit. And then that allows, the next point, the price then that needs to be charged for what you're selling. So, you need to understand your cost structure so that you can set an appropriate price, and the price has to cover, each physical cost of making what you're doing. And then also the break-even point allows you to decide on changes in pricing or changes in costs and how those would affect ultimately the firm's profit. So to calculate break-even, first of all by formula, we calculate it as fixed cost, total fixed cost on the top line divided by contribution, i.e. selling price minus variable costs on the bottom line. And there's a wee analogy to help explain how this works. Obviously, the contribution is very important. This word C, or contribution per unit, is very important. So, if we use the example that revenue that's earned from sales is a jug of water, or water that goes into a jug from a tap. And the water tap is running continuously, hopefully. Revenue keeps coming. And the jug keeps filling up. You can keep filling up your jug when you put the jug under the tap. And you're going to tip the jug and to start to empty the jug to cover your costs. The revenue's coming in, you've got to cover your costs. So the first costs the business has to cover is its variable costs. It's wages, it's raw materials. Because, of course, if you don't pay your workers and you haven't got stocks and supplies paid for, you don't have anything to sell. You can't operate as a business. So we will use a basin as an example. It's not a basin, a bowl as to represent variable costs. We're going to use a basin, like a basin in a sink in a utility room, as the analogy of the fixed cost scenario, and we are going to set the bowl inside the basin and the basin inside the bathtub. And the bowl, okay, is your variable costs, and as the revenue is pouring in, i.e. your jug of water is pouring in, the bowl has to fill to the top and be covered before it will flow over into the basin below. And ideally, you want enough revenue coming from the tap and to continue to fill into that jug, and the jug keeps tipping as it's filled up, keeps tipping. And the fixed costs basin is filling up, and ideally it reaches the top of the basin, and there's still revenue coming in, and the water's still flowing, and it overflows over the basin. And of course, where's it going to go? It's going to go into the bathtub below. And we're hoping the same scenario continues. Revenue keeps coming, so the water's being tipped or running into the jug, and the jug keeps tipping the water in, and now the water in the bath starting to fill up. And what does the bath represent? The profit. So the contribution is your revenue. The contribution in large is your revenue. But what the business is really trying to understand is, out of that revenue, out of each selling price, how much of that selling price contributes to each unit, okay, that you're making and selling, right? As in, it contributes towards profit. So first of all, we've got to deduct the variable costs of each, okay, pound sold or £5 sold. Then we've got to work out the physical fixed costs for each unit, okay, that has to be covered and of the business. And then what's left from that selling price is the contribution, okay, that's going to contribute towards profit. Now, if you can, in your mind, remember the diagram of the break-even chart. I'll talk you through this slowly, just to see if you can put this into your mind. You have your y-axis and you have your x-axis. Okay, y-axis is y's up, so that's your vertical axis, and you have your x-axis. On a break-even chart, okay, the first thing we will plot is a fixed cost line. And a fixed cost line will go horizontally, okay, in line with your x-axis at some point originating from the y-axis at a value. So say, for example, £10,000. By the way, Y represents cost and revenue. And your x-axis, of course, is output. Okay, so at £10,000, we have a fixed cost line because the fixed cost of the business are £10,000. So horizontal line drawn from £10,000 of value on the y-axis straight across, okay, simultaneously or in line, with your x-axis. Now, then we're going to plot, okay, the total cost line. Now remember, the total cost line is made up of fixed costs plus variable costs. So at each unit of output, remember, 0 units, 0 variable costs, but we do have fixed costs. What have we got? We've got £10,000. So that will be our first point that we plot when we start to point a total cost line. It always starts at the point of the fixed cost line. And coincidentally then rises, okay, at a gradient okay, in response to FC plus VC. So we've got an upward sloping total cost line originating at the £10,000 figure. Okay. We then have to plot our total revenue line, because really what we're trying to find out is at what point does this TC and TR line intersect. That's the break-even point. So, of course, total revenue, we're going to start, and it's going to firstly plot it at 0 origin. 0, why? No sales, no revenue. And then consequently, your total revenue line will rise proportionately with output in response to your output multiplied by your selling price of each unit sold. So your total revenue line is now going to rise steadily from 0 and intersect somewhere across your total cost line, and that is deemed your break-even point. You would drop a line down to your x-axis just to signify what that point is, i.e. how many units, 500 units say, or 600 or 1,000, whatever it is, okay? And then, okay, you would shade on your graph your area of profit and area of loss. So, of course, to the left of the break-even point is like an isosceles diagram of triangle, and that is your loss-making, okay, area, shaded. And to the right of your break-even point, every unit above that 500 units is a profit-making unit, up to, obviously, until what you are producing and selling. Okay, and you shade that as profit. The last thing that you have to label on then the break-even chart would be your margin of safety. Now, what is margin of safety? Margin of safety is the number of units which you as a business are safely selling and making a profit from. Okay, so any area within this is a profit-making sale. So basically, that is between 500 units and the maximum units that are being produced and sold. So say it tells you the business is currently producing 1,000 units a week, or the business is currently sells 1,000 units a week, okay, as a business. Well, then the margin of safety would be between 500 and 1,000 units. And you would demonstrate that on your break-even chart with an arrow from the break-even point across, okay, to the end of your x-axis, or indeed the actual physical units told to you as the current capacity of the units of production or the current sales level of production. So that is the break-even, okay, diagram, and the formula we've said is the fixed cost on the top line divided by selling price minus variable costs on the bottom line. I will just pause for a moment, and then we are going to look at and recap on the evaluation of break-even as an analytical tool for business. So, just to recap, the contribution, okay, is the method used to calculate how much an individual product contributes to the fixed costs or the profits. It focuses on the returns a business makes from each unit of product sold and whether that return is enough to allow the business to make money overall after taking account of its fixed costs. The contribution would be the money per unit that covers the fixed costs. Once these fixed costs are covered, a profit is then made. To evaluate a break-even as an analytical tool, its advantages are that it is an easy visual method of analysing business performance. It indicates sales level required to achieve break-even, and therefore can assist with target setting in terms of production or units to be sold. It can be shown by a calculation, by a graph, and showing the profits at various output levels. It can be useful to calculate output levels needed to achieve target profit levels. Now, how would that be done? Well, if you wanted to make a profit of 20 grand, you would put the 20 grand figure on the top line of your break-even formula alongside fixed costs, and then are dividing by your contribution per unit. That will give you a physical unit of output that the business would have to make and sell to be in that profit-making target and achieving it. It allows you to forward plan, so it can be built into part of your business planning overall. You can work out in advance how many products it should produce and sell to cover its costs. Therefore, the business can set itself weekly or monthly production and sales targets. Using the formula, the business can alter selling price, fixed and variable cost to see the impact it can have on the break-even point. And lastly, businesses can be more confident that they will make a profit if it works out the margin of safety. However, the disadvantages of break-even analysis is that it is only an aid and it can be seen as too simplistic. It does assume that all output is sold and no stocks are held, and that is not really the case in the real world of business. It is a static model, so the analytical model is a static model, and of course business conditions change daily. It assumes a linear relationship between key variables, for example, costs and revenue, and it does ignore the concept of economies and diseconomies of scale that can set in as businesses grow larger and they are squeezing unit costs. Data may be inaccurate, rendering analysis of a limited value overall. This can affect the quality of the analysis, and it can be difficult to apply to a multi-product environment. So businesses that have large product portfolios with many products to sell, it's very difficult to analyse break-even on a one product or a one unit base, because obviously different products have a different break-even point. And that's the end of break-even analysis.